another 1.2 million homes in 2011. Number of REOs in the United States: 2006, 268,532. 2007, 404,849. 2008, 861,664. 2009, 918,376. 2010, 1,050,500. Total, 3,503,921. Source, RealtyTrack, www.realtytrack.com. To say it's a buyer's market is a vast understatement. If you are an investor who knows how to capitalize and profit, this is your time and your opportunity to cash in, full-time or part-time, to create a secure financial future for yourself and your loved ones. What is bank-owned real estate? When a homeowner misses 3 or more mortgage payments, the number varies by state, the property goes into default, and typically the foreclosure process begins. However, not all homes that lapse into foreclosure end up foreclosed or bank-owned. A homeowner in default, for example, could make up the missed payments or sell the property to an investor or another buyer. But in many cases, foreclosure does occur. If no one then buys the property at auction, it ends up as an REO, a bank-owned property. Today, hundreds of thousands of homes worth millions of dollars have become REOs. Because banks aren't in the primary business of owning real estate, instead they lend money, issue credit cards, and provide other financial services, the REOs tie up banks' valuable lending capital and wreak havoc on their balance sheets. That's why banks are willing to unload the properties at a fraction of their real worth, for pennies on the dollar. This is the greatest time in history to buy a house, real estate genius Donald Trump said in an interview with Sean Hannity. Even if you don't have money, the banks will make you a deal. www.realestatewebprofits.com/Trump. Pennies on the dollar. Just how much are banks willing to deal? Discounts can be as low as 50 cents on the dollar, and even lower in some cases. That's because many banks are struggling to get out from under bulging portfolios of repossessed properties they don't want. Non-producing assets. Each REO is an empty house that's considered a non-producing asset. It weighs down a bank's balance sheet, costs the bank money to maintain, and can have a detrimental effect on the bank's ability to loan money. For each non-producing asset, banks are required to have offsetting liabilities that show up as loan loss reserves on their balance sheets. Banks use complicated formulas to determine the amount of loan loss reserves required. In the banking industry, capital, or net worth, is the difference between the bank's total assets and its total liabilities. An increase in liabilities, REOs, squeezes or shrinks the bank's capital reserves. With a smaller capital reserve, a bank may face higher costs to borrow money from the Federal Reserve Bank. That's the money a bank typically lends out. If the bank has a big enough loan loss reserve, the Fed may prohibit it entirely from making further loans until it reduces its loan loss reserve. That can be accomplished by getting rid of, selling off, its REO properties. So the banks want to sell, and if your approach is right, they'll do so usually quickly and cleanly. Today you can find hundreds of millions of dollars in real estate owned by banks. And not just in California, Nevada, Texas, and Florida, states with the highest foreclosure rates. It's happening all across America. Never before have home prices been this low, combined with super low interest rates. Homes in the United States are on sale. Real deals. In 2010, I went shopping for bank-owned real estate and picked up several properties on sale in Southern California, each for less than $162,000 and at 60 to 65% of their market value. The after-repair value, ARV, in today's market of each of the homes ranges from $200,000 to $250,000. I bought a property on West Rosewood Street in Rialto, California.